Hello and welcome to the weekly special episode of the Daily Brief, which we call as the Weekly Brief. Here we collect and bring together all the best stories that we've covered through the entire week. So let's begin. See, the markets are a weird place. All that investors and traders want is certainty, but that is the only thing that you cannot get in the stock market. The other thing about most traders and investors is that they expect things to continue. So, when times are good, they think that good times will last forever, and when times are bad, they tend to think that bad times will continue for a long time. Now, things have been really good so far this year. Barring some minor bumps here and there, global markets have steadily gone up, but it looks like trouble may be on the horizon. The markets have started August on a bumpy note. Yesterday, the Nifty 50 in India was down by more than 2.5%. Last week, the US markets were down by 3%, but the real bloodbath was in the Japanese markets. In just the last 5 days, the Nikkei, which is like Nifty for Japan, has gone down by almost 18%. But why are the markets falling all of a sudden, you might be wondering? Well, the most honest answer is nobody knows. See, like I also said earlier, we all hate uncertainty and crave explanations for every single market event. But let's for once think about what the stock market really is. See, stock market is basically a meeting place where millions of people come together to express their bullish or their bearish views. And what we see as a result is one single price on our screens. So how can we really say why the market goes up or down, not just yesterday, but on any given day? But still, that said, we can probably guess the reason why the markets seem depressed. See, in the short term, the markets move more on sentiments and flows rather than on fundamentals. Starting from last week, the sentiment has been absolutely terrible. Possibly the single biggest factor causing the markets to fall may be what is happening in Japan. I'll give you some quick background. See, the Japanese real estate bubble burst in the 1990s, and along with real estate prices, the Japanese stock market also crashed. In fact, the Japanese stock market took more than 30 years to recover from these losses. The crash also led to a prolonged period of low economic growth and low inflation or deflation. In response, the Bank of Japan started aggressively cutting interest rates. By 1999, the interest rates hit zero, and they stayed near zero and sometimes even negative from 2000 to date. Now, this deflationary burst had a peculiar side effect. It led to the rise of something called carry trades. Now, in simple terms, a carry trade is where a trader borrows money at a low interest rate currency and then invests in a higher yielding asset. For example, you know that Japan has zero interest rates and that the US government bonds yield about 3%. What you can do is borrow in the yen or the funding currency at a low interest rate and invest in US dollar assets like US government bonds, which yield about 3%. The difference is your profit. Now, this sounds simple and attractive, right? Well, yes, as well as no. This trade will do well as long as the Japanese yen depreciates or if Japanese interest rates stay the same or even fall down. But if the yen or the Japanese rates rise, you will make less money or you will even start to lose money. On the flip side though, if the US interest rates or the dollar starts falling, you lose money as well. For a carry trade to be successful, the currency in which you are borrowing or the funding currency should ideally remain stable or depreciate against the currency in which you are investing or the target currency. Now, the Japanese yen has been really weak against the US dollar for many decades now, barring some occasional spikes. Now, this over time has made the yen the favorite borrowing currency for carry trades. Large traders, hedge funds, and other institutions would borrow in the yen and invest in dollar assets like bonds and stocks. Some would even leverage these trades further. Now, the yen was very weak for a large part of this year, but it suddenly started weakening in the run up to the Bank of Japan's meeting on July 31st. In that meeting, the Bank of Japan increased interest rates for the first time in a very long time, and the yen appreciated dramatically after that. Now, if you remember, the yen going up is bad for currency trades. Now, suddenly, all the people who had borrowed money in the yen were making less money on this carry trade, and some even started to lose money. So, they were forced to close trades like going long on US bonds and stocks funded by yen. Now, this puts further pressure on the yen. A rising yen is bad for an export-oriented economy like Japan. This negativity, along with deleveraging of Japanese domestic investors, selling by foreign investors in Japanese stocks, and further short positions by investors, is leading to vicious feedback loop. Now, of course, I'm oversimplifying this, but this is largely the gist. The other big factor that is causing turmoil both in Japan and globally is the perceived deterioration of the US economy. See, last week the US released its job data and it was very disappointing. This is causing concerns that the US Federal Reserve might have made a mistake by keeping interest rates high, and this will inevitably lead to a recession in the US. Now, why I am mentioning this is because there is a very popular saying which says, if the US sneezes, the rest of the world inevitably catches a cold. Now, given that sentiment drives markets in the short run, the Indian markets are not immune to the bad vibes as well. Now, moving on to the next story, let's talk about whether gold will still continue to shine or not. See, I know we've been talking a lot about gold, but the thing is, gold continues to make news all the time. If you remember, in the budget, government cut customs duty on gold from 15% to 6%. Now, this led to a very sharp fall in gold prices from about 7,300 per gram to about 6,700 per gram. Since the budget, prices have recovered to about 6,900 per gram, but this sharp fall in prices seems to have increased the demand for gold. The best sign of this is the fact that the Indian gold premium compared to international gold prices has vanished. Over the last few years, Indian gold has traded at a discount due to the poor demand and high customs duties, but suddenly the premium has all but vanished. This is because the fall in gold prices has led to an increase in demand for jewelry and other forms of gold. A recent Economic Times article reported that several jewelers are seeing double-digit increases in footfall ever since the fall in prices. The cut in gold import duty has come at a time when India heads into the festive season and a wedding season as well. Now, it is hard to know the actual number of weddings in India in a given year, but a recent Jeffries report put it at 80 lakhs to 1 crore. The period from November to December tends to be one of the busiest wedding periods of the country, and weddings also account for the bulk of jewelry purchases. Now, the budget was not just the only tailwind for gold. Central banks have also been one of the biggest sources of gold demand ever since the Russian invasion of Ukraine. The World Gold Council recently released the central bank gold buying data for June, and central banks brought 12 tons of gold. The RBI was one of the largest buyers of gold with the purchase of 9 tons, adding to the 800 tons of gold which it already holds. Till date, RBI is the second largest buyer of gold after China with a total purchase of nearly 38 tons. But since 2022, central banks have purchased nearly 2,500 tons of gold. The World Gold Council also recently did a survey of central banks and asked them whether they will add more gold or less gold to their reserves. Almost 30% of central banks said that they would increase the purchase, while 68% said that they would make no changes. The three big reasons why central banks are buying gold are interest rates, inflation, and geopolitical concerns. Gold will remain in focus this year because it typically has a negative relationship with interest rates. Also, do remember that gold prices are set in dollars. The US Federal Reserve is widely expected to cut interest rates in September, if not sooner. So if US interest rates do fall, gold prices will have another tailwind. More importantly, gold is perceived to be a hedge against geopolitical instability. So if the Middle East continues to become more unstable, or if outright war breaks out in the region, gold prices may continue to rally. Recently, the SEBI chairperson, Ms. Puri Bush, addressed a conference gathering. She spoke at length about various issues related to the stock market and what SEBI is doing about them. One key topic she spoke about was SEBI's initiatives related to the ease of doing business in India. To implement this, SEBI has recently set up 16 working groups. These groups include various market stakeholders like exchanges, clearing corporations, depositories, brokers, listed companies, and AMCs, and also alternate investment funds. SEBI's larger idea here is to help businesses by reducing compliance burden, streamlining processes that are currently long and complicated, improving investor protection, and also facilitating faster access to capital. On the faster access to capital part, SEBI chair Ms. Puri Bush spoke at length about how SEBI is doing this. She mentioned that India ranks number 1 globally in terms of the total number of IPOs and new issuances. However, the problem is that our IPO processing time of about 3 to 4 months is still very slow. And that is why SEBI is now focused on reducing the processing time of IPOs. And as a solution, they are looking to create a demystified IPO document. Now, this demystified IPO document will be a template or fill-in-the-blank style document with key points to cover all details of a company. SEBI's idea through this is to make the process less intimidating for companies and more informative for investors. Now, since this information will be in a very specific format, the advantage that it gives us is that it would automatically reduce the processing time for IPOs. By the way, here if you're wondering why faster processing of IPO application is important and how it really helps, let me explain it to you. See, a shorter timeline lowers the risk of market conditions changing between the IPO filing date and the IPO listing date. Now, given that the markets are very unpredictable, this is a very critical element. And more listings are positive and critical for the markets because of another interesting point that the SEBI chairperson mentioned during her speech. She pointed out that there is currently a mismatch between the demand and supply of securities in the market. I'll explain this to you in simpler words. See, in the last 3 years, about 3.1 lakh crore rupees have been invested in the secondary market every year by mutual funds, domestic institutional investors, and individual investors. But on the other hand, only 2 lakh crore rupees worth of new stocks have been issued each year through IPOs and follow-on public offerings. In other words, flows are chasing a limited number of securities in the market. According to SEBI, this is leading to an increase in the prices of existing stocks without much business growth to support it. Intuitively speaking, this is bad for the growth of our markets and the larger economy. Ambit Research also highlighted something on similar lines in a very recent report they released. They said that availability factor of Indian equities, which measures the ratio of available stocks to mutual funds demand, has been shrinking over the past 7 years. This is because the demand for Indian stocks from domestic mutual funds has grown faster than the supply of freely tradable shares. The effect has been most pronounced in large cap stocks where the availability factor has decreased by 48% as compared to 33% for mid caps and 27% for small cap stocks. In the last year alone, large cap availability factor or AF dropped by about 9%. This trend has led to higher stock prices as more money chases a limited supply of shares, particularly in the large cap segment. See, UPI is growing massively in India, and along with it, we are also experiencing a very fast growth in credit transactions. These transactions have touched about 10,000 crore rupees per month on UPI until now. Currently, there are two ways in which credit transactions work on UPI. First is RuPay credit card transactions, and second are bank credit lines. Now, out of these two, credit card transactions make up the majority, while credit line transactions are still a very small portion of about 100 to 200 crore rupees. Now, because of convenience of being able to pay via UPI, RuPay credit cards are gaining a lot of popularity in India. They now account for about 1/4 of all new credit cards issued in the country. A credit line, on the other hand, though, is essentially only like a pre-approved loan or overdraft facility that is provided by a bank. This can be accessed via UPI without the need of a physical card. Now, both credit cards and credit lines offer very similar benefits to users, which is a free credit period of 30 to 45 days before any interest is charged on the borrowed amount. But the key difference is that credit lines don't really require a physical card, which potentially can make them more convenient for users. Yet, credit line usage on UPI is still very low as compared to credit cards. The main reason for this probably is due to the MDR or merchant discount rate. See, MDR is the fee that a merchant has to pay when they accept certain types of payments on their account. For example, for a RuPay credit card, there is a 2% MDR, out of which 1 to 1.5% goes to the card issuing bank. Now, this helps bank cover the cost associated with providing interest-free periods. The problem today is that there is no MDR for credit line transactions on UPI. This means banks don't really earn any fee from these transactions, and thus it makes them less profitable than non-UPI credit card transactions. Now, because of this, only a very few banks offer credit lines on UPI, and that also only to remain competitive in the market. As more and more banks and users adopt this feature, it may increase competition, lower prices, and therefore reduce the bank's earnings from credit card MDR. Thus, it is possible that credit line transactions will also include an MDR in the future to make them more financially viable for banks. In the next story, I want to talk about a recent drama that is happening with Amazon India's operations. Manish Tiwari, who headed Amazon India's operations since 2020, has decided to step down. An article by The Arc has mentioned two reasons for this. First, Tiwari disagreed on Amazon India's strategy with Amit Agarwal, who is Manish Tiwari's predecessor and senior. And second, Amazon has been slowly losing market share in top cities of India to quick commerce companies in some categories. Now, Tiwari will stay with Amazon until October, which is a crucial time for the company because of festival sales. But interestingly, Amazon has not announced any replacement for him yet. Now, in case you're wondering why I'm even talking about this, it is because Amazon has recently been facing a threat of losing market share to quick commerce players like Blinkit and Zepto. If you've been following what's happening around, you would know that quick commerce players have now started to sell things like electronics and apparel in addition to the groceries and daily needs that they were already selling. According to some estimates, electronics makes up between 40 to 50% of all sales on Amazon and Flipkart. So if this threat is true, it will be massive. What quick commerce players are betting on is that Indian consumers will soon get used to quicker deliveries and will prefer them over traditional e-commerce players like Amazon. Now, while this is already happening in the grocery segment, it remains to be seen if consumers will start preferring convenience and higher prices over lower prices on Amazon but slower delivery across other categories. Now, while this is only a thesis and a hope right now, the adoption of quick commerce has been unreal so far. So this can definitely not be discounted. And therefore, a leadership change at this juncture could be a really big blow for Amazon. Until now, Amazon has invested over $7 billion into the Indian market and its revenues are starting to flatten out now. To give you some context, in FY23, Amazon's business saw only 3.4% revenue growth, while their marketplace entities saw losses increase by 33% to almost 5,000 crores. But this is not just about the numbers. Amazon is currently fighting intense competition in both urban and rural parts of India. In urban areas, quick commerce companies like Blinkit, Swiggy, Instamart and Zepto are squeezing Amazon with super fast delivery promises. Meanwhile, in smaller towns, Flipkart and Meesho have established much stronger footholds. Meesho especially has seen some phenomenal growth in the last few months. In fact, it also recently surpassed Amazon in terms of monthly active users on its mobile app. This means more Indians are spending time on Meesho's mobile app than on Amazon. Now, according to Money Control, a top seller on Amazon recently said, and I quote, "Amazon India's hunger to do business is nothing like it used to be earlier. The company has become extremely bureaucratic and it no longer enjoys the edge it once had." But on a positive note, things aren't so bad for Amazon on all fronts. With e-commerce getting harder by the day, they are now looking to shift their focus towards their cash-generating cloud computing business AWS. This is also visible from the numbers. AWS India's revenue grew by 43% in FY23 and crossed 12,000 crore rupees. For your context, AWS is the world's largest cloud computing company with over 30% market share, and Amazon globally makes close to $100 billion in revenue through it every single year. But all said and done, Amazon is still very bullish about being able to capture India. Their plan is to invest an additional $15 billion into the country by 2030. Out of this, a massive $12.7 billion is dedicated to AWS alone. In fact, if the media is to be believed, Amazon is also eyeing to buy out Swiggy's Instamart business in order to make their entry into the red-hot quick commerce segment. But as things stand right now, it looks like in the times of crisis, Amazon is returning to its cash-generating machine AWS until they figure out how to navigate this mess. This space has definitely gotten a lot of excitement brewing around it. These business wars are likely to continue for a while now, and I'll be sure to cover more about this story as and more I have more details. That's all the news I have for you today. I hope you found value in this episode. I'll see you tomorrow. Take care and goodbye.